What's going on?
Real estate life.
There you go. And today we're going to do an Ask Anton. So we've got multiple questions, very relevant for what's going on right now, kind of like hot topics.
Yep.
And the first one being this statistic about record new home starts. Is it true? And can you kind of dig into this?
Yeah.
No pun intended. About why people are
Land development dig into this.
are announcing this because I'm kind of confused by this statement.
This is your biggest opportunity in real estate in 2023 is new home building, new construction. What's happening is the sellers who would normally sell their home and move up are not moving. The lock-in effect. We've talked about this on previous ones. So inventory is down because what seller wants to take their 3% mortgage and trade it in for a 7? So who's there to backfill that? Pun intended. The builders and the developers. So the U.S. Census Bureau releases this data. And so this is pretty good concrete data that comes out. And the actual number was 763,000 sales of new homes. Blew expectations out of the water. It beat last month by 12.2%, and it beat the previous May by 20%. What's basically happening is because that seller is not selling their home, the builder is filling in the gap. But Anton, prices are going down. Everything's falling apart. We're actually more scared of the recession word as a consumer than a builder. Most builders have seen over long periods of time cycles. And what they do is as big cycles start to move, they know when to go. All of the local builders here in the Seattle metro and the nationals are going in again right now. They're buying inventory. So you, our listener, go flip a home, go build a home, go put a manufactured home on a lot. There is opportunity. Let me caveat this though. Don't go build luxury homes right now. So when you look at this and really dig into it, the median sales price, now this is for the US, so of course in the Seattle metro is higher, was $416, and the average sales price was $487,000. So when we talk about these new home numbers, we're not talking about, oh, the upper end, the luxury market is killing it. That part's still getting beat up. So if I'm looking at it from a strategic opportunity perspective, I'm going to figure out where the holes are in my local market, and then I'm going to go build product in those holes or those niches, and I'm going to avoid the upper end and the luxury market. Another way to look at this is Bloomberg also put out some numbers, and they said nationally listings are down 7.1%, and we're down 38.6% from pre-pandemic levels. So inventory has to come from somewhere. So builders are filling in that gap because they can.
So when was the last time we had a boom in home starts, would you say?
Well, the last major boom was 2000, started basically almost in 99, but really peaked in 2003, 4, 5, and 6. And that's what scares people is they go, oh no, builders are building more. You can go into the U.S. Census data and you can look, it's all there. We are not back to the level of new construction we were before the Great Recession. So it goes up, building permits drop, and it's come up a little bit, and new sales has come up a little bit, but you're not back to the 2005, 6, and 7 levels of new construction.
So why would they put record new home starts? Is that for a certain period of time?
Record new home starts is over the last 10 years.
So this is why I wanted you to clarify this because when I saw that automatically, I thought more generally, and I thought, oh, that's so crazy. Because I remember last time this happened, it was the beginning of the bubble popping, basically, right? So putting into context. Also, another thing that's unique too, why this is different, even if it even flirted with getting to that big, we also had a lot of people selling homes. So there was a lot of activity happening versus now it's like almost non-existent because people don't want to move into a higher priced mortgage, right? Higher interest rate.
Like we've talked about, it's about 40% less. I mean, some markets, so we're blanketing the whole U.S. when we say this, but there's about 40% less sales happening on a national level right now. If you go back to right before the Great Recession, that's not what was happening. We were having record sales. So you have less sales right now. So, well, what's that mean? That's opportunity for you as an investor to go be a small builder, go find some lots, hunt them down, get them ready for the market, whatever it may be, but take advantage of this opportunity, because if the national builders are bullish and they've got tons of money, I'm talking the LGIs, the Pulte Homes, the DR Hortons, if they're bullish, well, they have more money than us. Follow the big boys.
Is it a good time to build a home if you're just building for yourself or doing a small development?
It's a good time to build a home for yourself if you know enough contractors. So in the Seattle Metro, for example, we have a massive construction labor shortage. I don't know that you could build a home for yourself today and build it cheaper than just buying a new construction. Other markets, if you have more new construction labor available, you could probably do well. Generally speaking, you should be able to build in a 5 to a 10% equity doing it yourself. Now, having said all that, from an emotional perspective, when you build your own home, you get exactly what you want. So if you're not doing it just for dollars and we're doing it just for emotions, cool.
And you pay for it.
Yeah. And you pay for it. You pay for it also in the stress.
Yeah, totally. It's underrated what the builders deal with when they're building you a home, and you don't see it in the cost because they're, it's all about the margins for them. It's about scale. But when you do it by yourself, that's a whole nother podcast, right? Yeah. Like what headaches you should expect when building your own home.
That's a great one. I'm going to write it down.
And so I guess my last question on this topic is, what does that mean for real estate in the next 6 to 12 months, maybe next couple of years? Or does it mean nothing? It just means that they're just taking the opportunity to build homes because that is their business.
They're taking the opportunity to build homes, but if you flip the coin over, building permits slowed down over the last 6 months. So that's actually just going to exacerbate the inventory problem. So even though they built a bunch of them, and people like to quote this stat, so there's approximately 6.7 months worth of new construction inventory. The problem with that is every phase that's permitted, just put the foundation in, building the house, hitting the market. Well, what's actually available for sale? Probably 1 month of that, like the regular market, if not less. Once again, your local metro may vary a little bit, but they like to crash bros. People, the fear mongers like to throw that one out there like, oh, well, it's basically a buyer's market in new construction. No, that's the whole life cycle of the build. What's actually available on the market? Available on the market is low.
The next question is, home prices rose for third straight month in April, right? S&P Case-Shiller Index says. Can you talk about this? Because, sitting here last year, probably didn't think that this would happen.
Like we talked about, before, I was wrong. Maybe my emotional scars from 2008 were still there, but I thought our market was going to drop 10, 15%, or at least 7%.
To be fair, though, you were on the more conservative side of that. Even I was more dramatic, more like, so you were just like hedging a little bit because of inventory. So I just want to remind you, and also we still got 6 more months.
We got 6 more months, so I appreciate that, and I've heard this one from other people too. We're going to finish the year positive in 2023, and we were barely negative in 2022. Case-Shiller, though, is one of those ones just because it's a brand name. It's been around forever, so people like to look at it. First off, with the Case-Shiller Index, let's realize it's very much a lagging data point. So they're talking about April's numbers, and as we record this, we're in the end of June. So for the Seattle Metro, our local stats will pop out. Today is June 29th, July 1st. So, and we look at those, on July 1st, where are we at? What are we doing? So Case-Shiller is, 60 days late to the party. What they did say, though, was 22 versus 23 in April were up 0.5%. Woo, no big deal. But prices are down 2.4% from the peak. So some media articles, because I went and looked before, we did this. You've always kind of taught me, hey, look at YouTube, look at Twitter, look at the articles to see what people are saying. People are reporting this down 2.4% like it's a bad thing. Seattle Metro, we're up for the year. Your local market may be up, but 2.4% is minimal. And this is lagging. I believe most of the U.S. is already showing a positive increase in prices due to the lack of inventory, due to the lock-in effect of, once again, that seller who has the 3% mortgage who would normally be 30% of the market just coming in or more when they move up. They're staying there because it's too expensive for them to sell their home and trade up. Lastly, I think you've got to look at, we've been trained by the stock market to look at things like it's happening instantly. Real estate is not an instant transaction. And quite often they call it a illiquid asset because it takes time to sell it. The market moves so much slower. So when you're looking at real estate, even investors, generally speaking, they don't own properties for months or days. They own them for years, and homeowners do the same thing. They own them for years. So I think a better perspective is to look at it over the long run. The long run right now is the United States is going to continue above average appreciation. And here locally in the Seattle Metro, we are 1,000% going to continue the above average appreciation trend. And you've already seen that in the February to May numbers, and the June numbers are just going to show it even worse due to that lack of inventory. Your opportunity, build, buy rentals. Build, buy rentals. Like, I'm just going to keep nailing that. Also, your opportunity is to ignore the national news and figure out what's happening in your local market, understand that local market, because every local market, we like to talk about real estate nationally, but real estate is actually a local market in each city, in each neighborhood, in each county. The county could be performing one way, and a community inside that city could be performing completely different.
If you are looking at your own market and say you don't have a real estate agent, or maybe you do have an agent that you want to ask this of them, what data points should you be looking at in a market to know the trend and the trajectory of house prices, and then generally the temperature of real estate in your area?
The supply and demand is what rules real estate. It's simple economics. And so that's what you're going to be looking at to understand the temperature of the market. This will work in any market. I'm going to provide some examples from our local Seattle Metro. But if you want to know what direction a market is headed, you need to first look at the active listing numbers. Are the active listings growing or are they shrinking? Now realize there's a seasonality to real estate, especially here in the Seattle Metro. It rains a ton during the winter. Okay, so people don't like buying homes and pouring down rain. And then the sun starts to come out in the spring, and the spring market naturally hits and inventory rises. So realize, one, with real estate, there's always seasonality. But what you're trying to do is you're trying to compare those active listings. What did it look like versus the previous month? And what did it look like versus the same time last year? What's it doing over the last 1, 2, 3, or 5 years? Where is it trending? Next, we then want to look at essentially the pendings. In other words, what's selling? How much is the market taking away from the supply? Is that pending number going up or down? Then we want to look at the months of supply of pendings. What that means is that's inventory. Most of the United States is in a low inventory situation, and here in the Seattle Metro, we're in a stupid low inventory situation. You can think of it like 6 months is a neutral market, below 6 months is a seller's market. Hardcore seller's market is basically anything below 2 months. We are in a hardcore seller's market in the Seattle Metro. But I think people don't get perspective, so I want to provide perspective. This is like you walk into the soup aisle at your favorite grocery store. There are 5 shelves with a month and a half worth of inventory, which is approximately what we have, it's like there's 2 rows of cans on one shelf and the other 5 are empty. That's what's causing the appreciation. Once again, track it over a time period. Compare it to other time period. Another metric you can look at, DOM, days on market. If days on market is starting to rise significantly, it's an indicator that the market is slowing down. If days on market is going down, it's an indicator the market is speeding up. If days on market is really low versus the historical average, it means it's hot. Historical average in our area is like 45 days. Days on market right now is like 12. Okay, well that means the market's hot. The amount of showings, moving on to a next metric, the amount of showings it takes for a property to go pending. This is a hard one to find, and you don't see it in most markets. We're blessed in the Seattle Metro that they provide us that data. This one also is a hard one to find. The average number of showings per listing. Let's kind of give people a real example here. If the average number of showings per listing is 11, and the average number of showings to get a pending is 15, you know that if you're just average, you're not selling. But if you got 20 showings and you didn't get an offer, you're probably overpriced. So there's ways to read this data. And this is the one people usually think about first. But notice how it's behind all these other ones, prices. Because these other ones are going to lead what happens to prices. But yes, if prices are rising, okay, your market's doing well. If prices are going down, the market's not doing that well. Bonus stuff.
You made a really good point here because it's not enough to know what data points to look at. It's the combination and the timing of it. For example, you just mentioned, say you have an average number of showings and say it's like 30, right? And nobody put in an offer. You didn't even get a phone call or anything like that. Well, in a market where the days on market is like 7, 14, even 30 days, that might be a problem. If you got 30 people at your showing, right? But then the days on market is 6 months, which is kind of extreme. Well, there's a reason for that, right? So in the first case, short days on market, you got 30 showings, no offer, you're probably overpriced.
Yep.
Probably. There's a lot of other well, there might not be other options. They're just better options, and you just maybe need to re-look at your listing.
You're helping your neighbor sell.
Yeah, exactly. Yeah, exactly. On the flip side, you might get 30 showings in a days on market environment that's like 3 months, 4 months, 6 months. And it's not reflective of the bad price, though. Like you might have to really, really lower the price. It just might be a completely buyer's market in that case, and they've just got a lot of options. And we saw this in 2008 and 9 and 10.
You're nailing it. That's exactly what we saw. So
this is why it's good to have an agent.
You need to grab an agent who understands the market, whether you're an investor or a consumer, who can guide you through the process and explain to you the numbers, because then you know if it's a good buy. You also can measure the competition you're going to receive on that. If the agent can't explain the numbers, find a better one. Call us, we'll explain them to you, no problem. Going back though to the Great Recession, okay? It's such a good example. Real estate is always about substitution, whether it's a hot market or a buyer's market. In that hardcore buyer's market during the Great Recession, you had those longer days on market. You get tons of showings, but a buyer had 50 homes they could look at. Today, that same buyer has 3 to 5. So that's the difference, and you have to kind of put these things into context. So when people say the market's going to crash, there's nothing coming that's going to force it to crash like it did before, because we don't have the builder inventory, we don't have the foreclosure, and people have equity. And the loan process changed so much that these people actually have skin in the game. If you can't get this from your agent, you can start to track it yourself using Zillow, Redfin, your favorite search app. The Redfin Data Center is a great one where you can go in and look at good data too. But you need to start understanding the market. Once again, whether you're a consumer or investor, if you track it and look at it on a regular basis, you then know what a deal is and you can buy it.
Yeah, let's just talk about that because this is good for people to understand. I used to be an agent, had access to the MLS. Don't have access anymore because I'm not an agent. So I still like to do my own research and I use Redfin. And so this is one quick way to look at a listing that was sold and figure out what's kind of the trajectory of your market. So you go to Redfin, go to most recently sold houses, look at the top 10, go to the days on market or how long it took to sell it. If it's under 2 weeks, like most of them are under 2 weeks, that's a hot market. If you're starting to see things like 30 days, 60 days, a majority of them, that means it's a slower market.
It's slowing down.
So that's just one example using Redfin, okay? Yep. And then this is how you really gauge the trajectory. Look at it over time.
Bingo.
And you put all those numbers together. Now, if you have an agent, my suggestion is you do your own research while they're also doing the research because you want to double check if they're paying attention.
Yeah, compare the two. I think you take it to a whole nother level. So once again, whether it's your agent's website, Zillow, Redfin, it's irrelevant where the data is coming from. Open up a Google Doc, take your buy box, put your buy box into the Google Doc. In other words, these are the 6 things that are my criteria. And then write out the average price per square foot, the average days on market, the amount of available inventory, and then start tracking it and go May, June, July, and just put inside of your buy box in a specific neighborhood or a city, drop that in there and manually do this data. And people go, I don't want to do that. I'm going to be honest with you. You're being lazy. Okay. We're talking about assets that are between $500,000 to $5 million. You could spend 20 minutes a week doing this. This is all going to take. What you're going to do, though, by doing this activity is you're going to teach yourself the market and your buy box, and then you'll have a feeling for whether or not this is a good deal that's backed up by good data. That's how you take that to the extreme and become the best at what we're talking about as an investor or even a consumer.
And the last thing I'll say on this, why it's important to not only look at your own data or have an agent give you the data, but do it over time, because what you'll find, something will come on the market, and based off of the trajectory that you're going, you'll be able to put in an offer, the right offer, and just get it versus kind of like shooting darts in the dark, right? Like it'll just, the bullseye will become way bigger. It'll be way closer, and you find this from the best investors. It's all in the numbers. It really is. It's not like looking at the front of the house and be like, that looks nice. I think it's a good deal. Boom, right?
You get to lower your emotions too. People they discount this one so much. Investors, they're emotional. Home buyers, emotional. So great. If I'm tracking the data and I'm using the data and I'm using my criteria, I can lower my emotional barrier to purchase, which just makes it easier.
That's why the data matters.
Bonus stuff for data points that you can track. Building permits. Your local county, your local city has to tell you the level of building permits. You can also go in and you can get copies of the number of development applications that's being submitted. You can figure out the amount of available building lots. Okay, if you're in an area, there's thousands of building lots available, well, that might affect prices negatively. If you're in an area and there's a few hundred and it's a large, city and there's 60,000 people that live there, well, that means prices are going up. Foreclosure rate. Track the foreclosure rate for the city you're looking in, for the county. Track the number of bankruptcies. If you see bankruptcies start to rise dramatically, pause, take a breath. What's going on? Look at population trends. If the city or county you're buying in, like the Seattle Metro, is growing, and next bonus one, and there's a low unemployment rate, and there's awesome jobs, Boeing, Microsoft, Facebook, you're a tech hub, a venture capital hub, you've got a port, I'm just talking about our metro. Those are things that draw people to the area. When we were in Tennessee, we were looking at investment properties where Ford was going to build a plant. Well, that's going to draw people to the area. Population was rising. Also, you want to look at land use trends. This is something people never look at. Is it getting harder to build and develop in that area? If it is, prices are going to go up. That's it. These are bonus things, but we always like to look at the first level of data and be lazy and be like, oh, yep, that makes sense. What if you layer in all these other things? Have you just lowered your risk significantly?
Yeah, and you're going to be able to pinpoint your market's trajectory versus national headlines.
Bingo. I can lower my emotion, I understand where we're going, and I can make full, educated decisions that's going to help me reach my financial goals.
Boom. Okay, cool. So, well, in that case, where do you find the most accurate real estate data as somebody that wants to do it on their own?
The most accurate real estate data, Redfin Data Center. Okay. And I'm not even a Redfin fan, but it's the best. It's simple, it's open to the public, and a lot of times you can go into all the major cities and you can look at this, things like that. Altos Research puts out great data that's very up to date. Most of the other things are going to be lagging. Okay. Also, if you don't have access to the MLS, you need to join an investment group. You need to find a real estate broker who is licensed in the area, and you need to make friends with them. Or you need to become one yourself. But you have to figure out a way to get to the data monthly, daily, weekly. So yes, I would use those resources, but I would also create a relationship with someone like us who is going to give that data to their consumers and their investors. So for example, I have a set of builders, developers, investors, and every month I produce data for them and I send them copies of the data. But in addition to that, I have commentary that I give them on it. The new home one that we just talked about, I actually sent that to probably the top 10 the day it came out. And I said, buckle up, boys, it's time to buy. And that was the title to the email. And I just sent them that with just a quick blurb of, hey, beat expectations, up 12.2%. Want to play? And so it was also a little salesy, but they're my homies too. They're my friends. And so they know that banter. But don't rely on just being a consumer. Like if you're going to be a hardcore investor or a hardcore consumer, find a hardcore real estate professional who's willing to have these conversations with you.
Last question on that note. If you do have an agent and you want to get data, what do you specifically ask for so that you get the right data from them?
I would go right back to the list that we just went through and ask for that again. You could also simply email us and we'll send you a copy of it. You can hit the text code up in the top right corner or the contact us.
Awesome. Okay, so last question. It's again a headline that you see, kind of, or just something that's happening in the economy that's confusing to me, and I'm sure a lot of other people. Stocks are rising. So the stock market, the Dow, the NASDAQ, S&P, typically we look at that as a temperature of the health of just the economy, right?
Yep.
And it's going up. Is this a sign of better times, or is this an illusion to be paranoid about? And how does it reflect on real estate?
Oh, love it. The stock market is a game of future predictions. And I'm not a hardcore stock guy. I've got a nice little portfolio, but I'd say the vast majority of my wealth is in real estate. So I have to caveat that. And as we know, I'm a finance guy. I'm a numbers guy. So I love just looking at this stuff. There is a correlation between the stock market going up and people buying real estate because they feel comfortable because there's an indicator that gives them a little thumbs up sign. So that's part of it. Typically, the stock market will bottom out and rebound before the end of a recession. And the stock market, because it's forward-looking, it's literally sitting there betting on the future. That's why that happens. So people thought in the original predictions were by right now we would be in a recession. And arguably in real estate, we are in a transaction-based recession. Okay, you can't have transactions down 40% and not call it a recession. But the economy is not in one because there's still a lot of cash and the job market is proving resilient, even though the Fed is sitting here just beating on us. Like, bam, bam. Jerome Powell was just, at his latest press conference again attacking us. If the stock market is going up, though, right now, the stock market is basically saying that I believe Jerome Powell is fighting inflation. I believe we're winning. I believe the economy is going to be strong. And to be honest, I generally agree with it. Do I think we're going to have the soft landing? Possibly. But it's not going to be a hard landing, and we probably are going to go through a mild recession. So the stock market is going up preemptively because it's a forward-looking indicator. If you look at all of the last recessions, okay, so in 2020, the recession year return was 16%. In 2008, it was negative 38.5. In 2001, negative 13. But what happens is as we come into these recessions, the stock market goes down quick right in the beginning, and then it comes out fast. So the stock market's basically saying we're already done with the recession. Okay. This is not stock advice. Don't go buy a bunch of stocks.
Also, all these data points just leave you more confused because there's some high numbers and low numbers. But it's interesting. Following year returns generally are up.
Generally are up. So what happens is right before the recession, you get the down. Following year return, and this is from 1945 to 2020, 3 out of the last 13 recessions showed a negative return afterwards. All the rest were positive. Here's just what I think of, and this probably applies more to real estate investing than the stock market. When there's a change and a transition and the stock market goes down or real estate changes, that's when I'm really thinking it's time to buy. I'm looking for big trends, and I'm not going to sit here and bet, but when one of these things happens, great, it's time to go in. It's time to buy. Now that we've seen a big return, don't expect another giant jump back. And could there be a pullback from where there is? I'm going to bet there's going to be a pullback on the stock market because we're not done with all the pain yet. We've still got to work through the inflation. We still got to work through higher unemployment. So that's coming. So I think there's going to be a pullback. And then, yes, I think it's going to go up again after that.
Yeah, and a couple things to consider about stock market right now. I'm not a stock investor, but what I know is majority of the gain is from 7 companies, right? Because of this AI craze that we're in. And so whenever you're in kind of a craze season, that kind of happens, and you should take that into context to understand the broader market. And then secondly, I think that there's just natural ups and downs, but it's all about the long-term trend. And if I looked at it this morning, I was like, oh, I wonder what the trend is over the last 2 years. This is bad for Biden, but this is the reality. It's going down. Even with this uptick, we went so far down, and we're just kind of going straight across versus up or down, but it's more down. And then real estate, and this, I'm curious because this is kind of my takeaway from being in real estate for 15, 16 years now. Real estate is slow to move. Sometimes it will follow the stock market, especially if that is the general kind of like feeling of where the market will be. But sometimes it doesn't care what the stock market does. It just kind of goes in its own direction. So it might go like this following the stock market, but like when things are really bad, it will just tank. And when things are really good, it just go up. There's just too many variables to use it. I think this goes back to the earlier conversation though. What's probably the most predictable is what's going to happen in the next 30 to 60 days. And that's all from data that you look at in the last 1 to 3 months.
Exactly.
Way more important. So at the end of the day, I would not suggest looking at the stock market to determine house prices or real estate trajectory, because the variables that do affect real estate oftentimes don't correlate with the stock market.
And the stock market also doesn't necessarily mean the economy. And the stock market doesn't mean what's happening in your local area. So Seattle's hot, okay? But I'm sure there's places in the Midwest that are cold. Okay. And, or maybe, up in Detroit, I don't know. So I'm just kind of making a guess real quick, but there's always going to be an area that is doing good and one that's not doing good. But they don't have to correlate. Going back to one thing that you said, the returns are coming in the Microsofts of the world, the big companies. What that also is, and I think people forget about this, is the M2 money supply shot up so significantly when we printed all of that money. And so as that cash ballooned out, that cash is also still seeking returns. So what happens is, as a sector or an area of the stock market starts to rise, or real estate, all that cash on the sidelines starts shooting in, trying to find a return. Because whether we like it or not, we just follow each other. So as that started to get the lift, everyone's like, well, I want to get in on the lift because I have this cash and I don't want to be left out. And that's not going to fundamentally change, because the M2 money supply is only, you can go to the Federal Reserve, you can look at this, it's only gone down a little bit. There's a lot of cash still in the system.
Word. And there's a lot of cash for real estate too.
Like we talked about, if you're not grabbing opportunities in real estate
or at
today,
least looking,
you're going to miss on probably the greatest opportunity since the Great Recession. Does that mean it's happening right now in your market? No, not necessarily, but it's going to happen over the next 24 months, and you've got to go make friends with someone who knows and understands your market, like us, who you could do business with and find amazing deals.
There you go. All right, so I guess I'll see you next week. If you guys have questions, leave them in the comments area, because I think it'd be good to pick topics from viewers.
100%. Thank you.